Hello, everybody, for today's session with Viking Ventures or Viking Growth, as the name is now. The name has just been changed since we launched this webinar. We are happy to have Viking Growth with us today. There's a lot of valuable information to learn from Viking. If you're a venture or private equity investor, you need to invest only in the best companies. And really, in order to make a return, therefore you need to have an extreme focus on value creation. Viking really has conceptualized value creation and the way to look at tech investments, especially around the SaaS Metrics suite. And there's great learnings in this value creation concept for all companies, not only companies looking for exit or investors. Everybody should really master these disciplines. So welcome to Martin from Viking. But before moving on to you, Martin, just a quick word and one slide about metrics, so we don't leave anyone totally in the dark about us. So we are SaaS Metrics specialists. We've been working with a large number of leading Danish companies on their metrics. We offer the Metriks platform, where you easily connect to a ERP system, and then you immediately get your SaaS metrics, your ARR, MRR, churn customers, retention, upselling, downselling, CAC customer lifetime value, and much more. We believe that SaaS metrics are relevant for all companies, including B2B and e-commerce. And we are always willing to spend an hour telling what we know about SaaS metrics and give you input on your SaaS metrics. Just message me, and then we can schedule a meeting. We happily do that without, free, with no obligations. We learn as well. So, and then we move on to Viking and Martin. If anybody has any questions, please write them on the comments below. And if you want to receive the presentation afterwards, just write presentation, and then we'll get it forwarded later on. Martin, you're already present in Denmark and have done investments here, right?
That's correct. I think we have we had 6 Danish investments. Now we have 5. So Paneo, happily or unluckily, was sold and is no longer in the presentation, but in the portfolio. But that was a great investment for us as well. So now there's 5 Danish companies in the portfolio.
Nice. Yeah, but looking forward really to hear what you're up to. And you just changed your name?
We just changed our name. So I think the venture in Viking Venture was something that we always needed to spend some time explaining, that, that's before we were a typical venture investment. Now we've moved on to a little bit of a different type of investing. So we feel like Viking Growth is a little bit more descriptive of what we actually do. But you're not the only one who struggles to remember the name change. We struggle ourselves from time to time.
I guess. All right, but interested. You're looking forward to hear what you have to say. So
perfect. Great. Well, hello and welcome to this webinar on how to value B2B SaaS companies, presented, as we've said a few times now, by Viking Growth, the Nordic software investor. My name is Martin Eriksen. I am a senior investment manager here at Viking, and have been working with SaaS KPIs and valuations of SaaS companies for pretty much since I started working at Viking for around 7 years ago. We have around 20-25 minutes, if I'm not mistaken, set aside for the presentation, and then there's 5 to 10 minutes at the end for any questions that you might have. So if there's any questions, make sure to use the Q&A function, and we'll try and answer everything at the end of the presentation. To start, we need to say a few things about Viking Growth, just who we are and what we do, but I promise to make it short so that we can get into the main topic of the webinar quickly. So, like I said, my name is Martin Eriksen. I work as a senior investment manager here at Viking. I have spent most of my time working on the investment side of things, focused on the Danish market. As Thomas was saying, myself and Avin were the 2 people here at Viking who started looking towards Denmark to make investments, and in the around I think it was 5 years that I was on the Danish team, we managed to invest in 5 Danish companies. And then as I was leaving, we invested in a 6 in Panera as well. So built up a really nice portfolio in Denmark. But I've also spent some time working in our operational excellence team, which is our in-house management consulting team that work purely towards the portfolio companies. Now I am back on the investment side of things, but now focusing more on Norway and Finland. But if there are any companies listening into the webinar today that would like to discuss a potential collaboration with Viking, then please get in touch after the presentation. We're always looking for new and exciting companies to invest in. So Viking Growth, who are we and what do we do? We help Nordic software companies scale, and that's all we do. We've had this singular focus for around 10 years now, which means we've built a base of knowledge and experience within the space, which makes us experts on the B2B SaaS business model. The types of companies that we invest in, as you can see from the table at the top left, B2B SaaS companies based in one of the Nordic countries. We look for companies with revenues between 3 and 10 million euros. And most importantly, we look for companies who have software which supports work processes. And what we mean by that is we look for companies to invest in that have software which is considered need to have by their customers and not nice to have. We are typically an active minority investor. However, we're pretty pragmatic, so we have no issue doing majority transaction as well, if that's relevant. The only thing that doesn't change is the active bit. We love to work closely with our companies, both through the board, but also operationally. Typically, we combine primaries and secondaries when we invest, putting money directly into the company, but also allowing existing owners to sell some shares if they wish to do so. We also tend to shy away from different share classes and preference structures when investing. And that's purely so that we can sit on the same side of the table as the founders and management after the investment. You can see our active portfolio to the right here with the colored logos. So like we've mentioned before already, we have companies based in all 4 Nordic countries with ARR ranging in the size of 40 million kroner to a billion kroner, and that's Norwegian kroner, so a little bit worth a little bit less than the Danish. But all the companies have different solutions. They cater to different markets and different verticals, but the one thing that they do have in common is the software as a service business model. So I mentioned that we are an active owner, and what you see here are the different areas that we like to focus on when working with our portfolio. Everything from growth strategies and pricing projects to debt financing and exits. The focus for today's session is on KPIs and benchmarks, as well as valuations. And this is an area that we've invested a lot of time and resources into developing, which hopefully you'll be able to see as we move along with the presentation. So now that we've finished the formal bit, we can get into the actual subject of today's presentation, which is valuations. And I think it makes sense to start by sharing what our main goals were when creating what we eventually called the Viking Growth Valuation Scorecard, and our main criteria for the model and what they were. So I've listed 5 main points here, which I'd like to spend a little bit of time discussing. The first criteria for the model was that it needed to be simple and easy to use. We wanted to create something that was logical, and I guess you could say, to be perfectly honest, we wanted to create something that was difficult to argue against. The second point is that it needed to be based on readily available KPIs. We wanted to use KPIs as the basis for our valuations, and we realized that if this was going to be simple and easy to use, then we needed to base it on readily available KPIs, which the majority of companies track. And as I'm sure most of you know, B2B SaaS is full of KPIs looking at a variety of different things. But to maintain that simplicity of the model, we decided to narrow our focus to the most common KPIs. The third point that we wanted to be able to calculate valuations quickly. one of our key strengths as an investor is that we're able to move really, really quickly. And that means we need a valuation model which enables us to maintain speed in the processes that we engage in. Now, as we continue to develop the model, we realize that it could be used for a lot more than just valuing potential investments. And this is where the fourth point comes into play. We wanted to create something and use this as an operational tool when working with our portfolio companies. So today we use the model to value potential investments, but we also use it to value our portfolio companies each quarter for our own quarterly reports. We use it to calculate forecasted valuations of our portfolio companies based on their 5-year business plans. And we also use it to value potential add-on acquisitions in the portfolio. So an example of that is when it comes to M&A, we use the model to value the target standalone, then we value our portfolio company standalone, and then we combine the two and value the combined entity as well, just to highlight any synergies that may come from the acquisition. So as you can see, it's an extremely valuable tool for us, both in terms of investing, but also as an operational tool when developing our portfolio companies. The last point is that the model needs to be accurate and it needs to reflect the current market. The scorecard that I'm presenting today is in no way the same scorecard that we created 6 years ago. The market is always changing and investor sentiment shifts. So we needed to make sure that the model was able to reflect this as well. And that's why we constantly check the model and calibrate it to actual transactions in the market, which we have insight to. But also we adjust it to basically highlight any significant shifts in investor sentiment. So I can give you an example of an adjustment that we've made. Organic growth has come down recently as it's much more difficult to sell to new customers than it has been before. We see this in a reduction of the average organic growth rates of publicly listed companies, but we also see it in the growth rates of our own portfolio. And a prior version of the model had 30% as the organic growth benchmark. And today, when we're looking at it a little bit closer, we see that the benchmark is actually closer to 20%. So we adjusted the model, which gives us valuations which more accurately reflect the current market. So now that we've given you a bit of the background, hopefully you have a better understanding of what we were trying to achieve. Now we can take a look at how we've actually chosen to build the model. So we value companies based on multiples, which we calculate by combining market sentiment with company-specific KPIs. So we start the valuation process with a market multiple, and I'll get back to exactly what that is on the next slide. But this is what dictates the starting point of our model. So as the market moves up or down, the starting point or the baseline of our model also moves up or down. Then we compare the relevant company's KPIs to benchmarks. And depending on the company's performance against the benchmark, they either receive a positive adjustment or a negative adjustment. So for example, a company that grows at a higher rate than the benchmark, they will receive a positive adjustment to their multiple. Finally, we add all of our positive and negative adjustments up and add this to our baseline, resulting in a final company-specific multiple. So we can dive into a little bit more of the details in the next couple of slides. So the market, if we start with that. Some of you may already be aware, but we have something called the Viking Growth Nordic SaaS Index. And this is an index that we've created to track the performance of listed Nordic SaaS companies. And if you're not already, you can subscribe to receive weekly updates on our website. So we compare the Viking Growth Nordic SaaS Index to something called the BVP Cloud Index. And for those of you who don't know, Bessemer Venture Partners is a renowned venture capital fund in the US, and they have created what they call the BVP Cloud Index, which includes the most renowned cloud companies in the world. And this index and the companies included have been around for a really long time, and we consider it to be a good indicator of where the market for software companies is. Now, given we invest in Nordic B2B SaaS companies, we obviously considered using our own index as a starting point for our valuations. But what we quickly realized was that we don't have the necessary history or maturity in listed Nordic SaaS companies to give us the necessary comfort that we need. So we pretty quickly decided to stick with the BVP Cloud Index as our starting point. Now, to remove some of the noise and volatility in the index, we use a trailing last 6-month average of the median BVP Cloud Index LTM EV revenue multiple. Now, that is that's a mouthful to say the least, but what it basically means is we take the LTM EV revenue multiple from the index and we smooth it out based on the last six months. And as you can see from the table at the bottom right, I think it is, the multiple here for last week was at 6.2x. So 6.2 times revenue would give you the enterprise value for a standard BVP Cloud Index company. So what you see here is the Viking Growth KPI Dashboard. And this is a collection of the most important SaaS KPIs split into 3 different categories. We have growth and profitability, customer acquisition cost and sales efficiency, and coverage model and sales process. So each month, our portfolio companies upload a number of data points into a Power BI report, which then calculates all of these KPIs, as well as a host of other things, which allows us to track performance month by month. So what that basically means is that I can log into our Power BI report right now, and I can see this view for any of the portfolio companies, as well as click on a specific KPI to see its development over time. And the reason this is important is it gives us valuable insight into the performance of our individual companies, but also of the portfolio as a whole. And together with what we see from the market, we use this to tell us something about how the markets are evolving for B2B SaaS. If we think back to the criteria and the overall goals of the model, and specifically the need for the model to be simple, we obviously can't include all of these KPIs, which is what we tried to do, but quickly realized that that was a bad idea. So the KPIs highlighted in red, those are the ones which are included in the valuation scorecard, either directly or indirectly. And these are both the most important KPIs when it comes to valuations, but they're also the KPIs which are publicly available for listed companies, which allows us to check and calibrate our model to the correlations between the individual KPI and valuation multiples. As I mentioned earlier, we look at the company's performance on a number of KPIs and we compare this to benchmarks. And depending on whether they're better or worse than the benchmark, they'll either receive a positive or negative adjustment to the scorecard. So in the table here, you can see we've listed all the KPIs which are included in the scorecard. We've added a short description, the relevant benchmark, as well as the relative weighting. So how big an effect each KPI has on the valuation of a company varies, which is why their weighting in the model also varies. And I think it makes sense to basically work our way down the list and say a little something about each KPI. So to start off with, we have liquidity discount. And this is a standard discount which is applied to private companies because their shares aren't as liquid as public companies. However, in this case, there's also a discount from listed US companies to private Nordic companies. For income mix, we look at the amount of revenue which is of a recurring nature. The benchmark here is 80%, which means that companies with a higher split of recurring revenue will receive a positive adjustment, and companies with less than 80% will receive a negative adjustment. When we look at growth, it's important to split total growth from organic growth. And when I say organic growth, what I mean is the sum of new sales, upsales, expansion, price adjustments, contraction, and churn. And this is worth much more than total growth, which can also include M&A and foreign exchange changes, for example. Organic growth is still by far the biggest driver to higher valuations, even if we have seen a shift towards investors wanting more profitable growth than we have previously. The benchmark here is set to 20%, which I mentioned earlier is down from around 30% previously. And given organic growth's importance to valuations, this KPI has a high weighting. For geographic presence, what we do here is we look at the company's customer portfolio and the amount of geographic markets that they're present in order for a company to add a new market, then they need at least 20% of their revenue from that market. And the reason we look at this is international expansion, as I'm sure a lot of you know, is really difficult. And this KPI looks to address that risk. So gross margin is SaaS gross margin in this case. And what SaaS gross margin is, it's the margin which is connected to our license revenue. And this means that we need to split costs and attribute them to the different revenue streams so that we can calculate the exact margin that we have on our software license sales. Benchmark here is set to 76 to 80%. So net revenue retention, or NRR, is an interesting KPI. And this looks at whether or not we're able to grow the ARR in our existing customer base. And if we go back a few years ago when new sales growth first started to decline, there was a lot of people in the market who were predicting NRR to become the biggest driver to valuations, that it was going to take over from organic growth. What we see is that this hasn't happened. Organic growth is still definitely the highest driver to valuations, and in particular, new sales growth. But NRR definitely has increased in terms of importance, and the benchmark here is set to 101 to 105%. So size is also an interesting KPI, and what we're doing here is we're comparing the companies that we invest in to some of the biggest companies in the world. So pretty much everyone is going to receive a negative adjustment when it comes to size, but this KPI looks at a lot more than just that. We don't give any credit to M&A, for example, because we split it out of the organic growth. But in terms of size, you'll get credit for any M&A that you do. It's also easier to grow at a high percentage as a small company than it is as a big one. So here you'll receive a negative adjustment for being a little bit of a smaller company as well. The benchmark here for size is set to 400 million Norwegian kroner. EBITDA is the KPI that looks at profitability. And again, we've seen a pretty big shift here in terms of investor sentiment, going from what we call a growth at all costs mindset to a more profitable growth or balanced growth mindset. The benchmark for EBITDA has increased. It was at around 0%. Now it's closer to 10 to 19%. And this KPI needs to be viewed together with organic growth, as there is, of course, a balance that needs to be struck here. The last three KPIs are software market, industry, and customers. And what we do here is we try to address the underlying risk in the company. So for software market, we're looking at the underlying growth in the software category. So if you have, for example, a workforce management software, what is the underlying growth in that software category? For industry, we want to make sure that we're not overexposed to a single industry. And finally, for customers, we want to make sure that the customer concentration isn't too high, making us dependent on a few large customers. So that's a quick rundown of the KPIs that we look at and their benchmarks and relative weighting. So now we can actually have a look at the actual scorecard and how that works. There we go. So what you see here is a screenshot of the Viking Growth Valuation Scorecard for Company X. And as we can see from the top left, Company X has 90% recurring revenue. It has 120 million in ARR, 20% organic growth, a geographic presence of world, 75% SaaS gross margin, 110% net revenue retention, 100 million in revenues, and 30% EBITDA margin. So it has some pretty good KPIs. So in this particular example, the last 6-month BVP Cloud Index has a median EV revenue multiple of 6.4. So this is the starting point for a model. Now, some of you might remember a time when B2B SaaS multiples were much higher than this. I think if we go back to, was it September 2021, the median BVP Cloud EV revenue multiple was actually at 16.4. So there's a big difference when we compare it to the valuations of today. But that also means that the model needs to adjust the positive and negative adjustments for each KPI relative to the change in the starting point. So what I mean by that is the adjustment to each KPI are much bigger when the starting point is at 16.4 than they are when the starting point is at 6.4. So it's a relative adjustment. Now when we compare KPIs 1 to 11 for company X against the relevant benchmarks, we can see the adjustments up or down under the BVP multiple. So first off, we see a big negative adjustment for the liquidity discount, which all non-listed companies receive. Company X then has a better percentage of recurring revenue than the benchmark. Organic growth is exactly at the benchmark. Geographic presence is as well. Gross margin slightly below. Net revenue retention slightly above. Size is, as we can see here, 120 million, which is less than the benchmark of 400. EBITDA is quite a bit above the benchmark, and software market, industry concentration, and customers are all above the benchmark. So when we sum all this together, we end up with a company-specific EV revenue multiple for company X of 5.1, which gives us an enterprise value of 512. And to convert this to an EV ARR multiple, we simply take 512 and divide that by the ARR, which gives us an EV ARR multiple of 4.3. So on the face of it, it's a very simple model. The complicated bit and where we've spent a lot of time and done a lot of analysis is in the level and weighting of the different adjustments. So why does an NRR of 110, for example, result in an adjustment to the multiple of 0.2x? And this is sort of what we would call Viking secret sauce, and what allows us to calculate accurate valuations really, really quickly. Perfect. So that actually sort of concludes the presentation and my slides for today. I hope you found it useful. And as Thomas mentioned, the slides will be made available. So anyone who wants to have the slides can probably download them at some point. And we probably have some time for some questions, Thomas.
Yeah, definitely. No, thank you, Martin. I find it so interesting, especially the link from day-to-day operations up to value creation. I think,
Yep.
That's the whole strength, I think, also about the SaaS Metrics suite and the way to work with SaaS Metrics. I got one question. Yeah, if anybody have questions, please let us know. But I have one question I'm just curious about, because you got an overview of the whole Scandinavian market, and I'm wondering, what is the differences? What differences do you see? And if you look especially on the Danish companies, where are there some things that maybe Danish companies could improve and learn on? Are there anything general? And yeah, maybe you can put some word. Maybe also, are there something that is a special advantage or strength in the Danish market compared to other markets? How do you see that?
Yeah, I think we as Viking, we've obviously, like you say, we've been working towards all the Nordic markets. The Finnish market is a little bit newer to us, so we haven't spent that much time working towards Finland. But I think what you can say is that Norway, Sweden, and Denmark, the markets are quite similar now. I would say there's not that big of a difference in terms of the companies, the SaaS companies and the SaaS environment in Norway, Sweden, and Denmark today than there was, for example, 5 years ago. I think if you go back 5 years ago, I think you would notice that maybe Norway was the least mature of the markets when it came to software and SaaS. Sweden was the most, and Denmark was sort of in between Norway and Sweden in terms of the maturity and level of the markets. And I think where Denmark has an advantage is that it seems to me, at least, that the Danish SaaS community is really tight knit, and it seems, at least as an investor, that almost everyone knows each other. And everyone draws on each other's sort of experiences, which is, I think, a really, really useful thing to do. And I think my opinion is that Nordic SaaS has matured an insane amount in the last, call it 4 or 5 years. Now I think people are really looking into KPIs and learning about KPIs and using them to run their businesses. And I think before, maybe the US was sort of the source of innovation when it came to SaaS, and they were the guys setting the agenda. But I think the Nordics has definitely increased in terms of maturity and innovation as well. So if you take a Nordic company and you present it to the US or to Germany or the UK, then Nordic, the fact that we're Nordic is sort of like a stamp of approval in terms of quality and security. So yeah, I think it's really good. I don't know if there's anything specific to Danish companies that I'd be able to pull out. I think we've all the Nordic countries have come a long way in the last couple of years.
Another question: how do you see international expansion? Because I think I experience it. I see that it's always a challenge when you start having a market share in your local markets.
Yep.
While expansion, cross-border and across is also always difficult. Also, yeah, the matureness of technology is different from country to country.
Yeah.
What is your view on that? A general question, I know, but
I think international expansion for us is one of the areas that we help the companies that we invest in with the most, and we see that that's sort of the topic that sort of engages the most people is, how do we expand internationally? Because I think the natural step is to become sort of get a really strong position in your home market, and then maybe expand to the other Nordic countries, and then from that position you can expand either to the UK, DACH, Benelux, US. Now there's a little bit of uncertainty in terms of the US. Just because of the changing sort of business environment there. You can't really trust that the situation or the way that the US is structured today is the way it's going to be structured also tomorrow. So that's maybe a little bit of a risk. But what we typically see is that the best way to go about international expansion is if you're able to get some international customers. So you get, for example, the Nordic branch of a big international customer, and then grow with your customers into international markets. So they take you into a new market, and you have sort of a starting point in that market, and then you can grow from that space. But typically, I think, again, there's been so many changes in the way that things have happened before. So before, if you went back 3 years, we would say, if you're a Norwegian company or a Danish company, then become the market leader in Denmark, expand to Norway and Sweden. And once you've done that, expand to either the UK, the US, or DACH, either through an acquisition or organically. Now, I think you can go from being a Danish company and having a really strong position in Denmark to expanding directly into the UK or directly into the US. That's not really an issue anymore. You don't need to sort of do step by step, obviously. But like I mentioned before, sort of Nordic software in today's market, at least our experience is that it sort of comes with a stamp of approval, and people are like, okay, it's a Nordic made software, and that must mean it's good.
Okay. Our last webinar we had Clearwater presenting, and one thing they recommended that was that all companies really need to know their own metrics, their own SaaS metrics, because if they don't, then they pass over an advantage to an investor who will know their figures better and can start negotiating and so on. Yep. I'm just curious, how do you see, what kind of shape do companies have when you meet them the first time? Where is it important to improve, and what shape do you see the numbers and KPIs from companies?
Yep. I think it varies greatly. So I think we've experienced speaking to software companies with a software as a service business model, and the company not knowing what ARR is, or annual recurring revenue, or anything, basically, running their business based on a traditional P&L. And then we have really, really small companies who have 100% control of all their KPIs and have been tracking it from day one. So it varies a lot, and I think investors will accept a varying degree of sort of KPIs and control of KPIs when companies are between 10 and 30 million in AR, for example. But the second you start growing quickly, or looking to get investors who are typically investing in bigger companies, then I would agree with Clearwater. And it was Per Sulland who you spoke to. But
exactly.
Yeah, and I would definitely say that my word of advice would be to start tracking. Choose your KPIs and start tracking them now, so that you have necessary history, and you have the necessary sort of maturity in your KPI deck, because there's a reason that investors are so focused on KPIs, and it's because the software as a service business model is unique in terms of the KPIs that you can use and the things that we can analyze to tell us something about where we might be going in the future. But yeah, to answer your question, it varies a lot, but again, it's gotten a lot better. And I think companies like yourself, are making it a little bit easier for companies to start tracking KPIs. And as an investor, I would say start working on KPIs now and sort of choose the most important KPIs to you and start tracking them from day one and build up that sort of history and KPI deck. It'll make discussions and presentations and pitches to investors much easier.
Good, thank you. Half an hour we reached. I know anybody who would like to, I suggest you to hook up with Martin on LinkedIn and follow Viking. Please also hook up and follow Metriks. We have the next webinar in June. We don't know the subject yet. We are just planning. So follow us on Metriks or on LinkedIn, and then we'll let you know. So thank you again, Martin.
No problem.
It's very interesting to hear, and thank you to everybody for listening in. Have a nice day.
Perfect. Thank you. Bye-bye.